I think we're actually in recession, although by the time they write the history books on this era, it may be considered a depression.
Peter Schiff, the renowned economic forecaster, is back with a dire warning. A recession worse than 2008 could be on the horizon. Hey there, welcome back to Cash Baggy. In this guide, I'll explore the uncertain economic terrain and prepare you to weather a potential storm that might be even more severe than the Great Recession. According to Yahoo Finance, this recession will be the most severe yet. Peter Schiff called the 2008 financial crash and now says the next downturn will be even worse. Here's what he likes for safety. By now, quite a few celebrities, including Elon Musk and Suze Orman, have predicted a recession would hit the U.S. economy. Peter Schiff, CEO and chief global strategist at Euro-Pacific Capital, is the latest expert to sound the alarm.
I think that the numbers that we get from the government are not accurate by design. So I don't really think that the economy is growing in any real sense. I think that the way they compute the numbers, I think, is deceiving. I think that for most Americans, their standard of living is declining. I don't think the economy is really getting bigger. I think we're spending more and we're borrowing more and going deeper into debt.
Schiff argues that government actions, including heightened spending and corporate taxes, are worsening inflation, attributing the actual cause of inflation to government money printing and debt monetization. Additionally, Schiff maintains that government-provided economic data is deliberately inaccurate, casting doubt on economic growth. He also asserts that the standard of living is declining, and he questions whether the economy is genuinely expanding or merely propped up by excessive borrowing and debt. Schiff contends that the reported growth in gross domestic product is distorted by inflation and debt. He argues that individuals struggle with rising living costs, evident in the record number of people holding multiple jobs, escalating credit card debt, and soaring student loan debt. He points out that in a robust economy, people typically pay off their debts and build savings. Still, the savings rate has plummeted in recent years.
Times were good, the government would be running smaller deficits. They would be collecting more taxes. They wouldn't be spending as much on government assistance. Our trade deficits are at record highs. If we had a booming economy, we'd be making more stuff. We'd be exporting that stuff, or we'd be importing less because we would just consume what we produced ourselves. But our economy is really shrinking, and that's why we're on life support. We're dependent on foreigners for all the goods that we can't produce, and we have to pay for it on credit because we don't have the real incomes or the savings to afford it.
Schiff's viewpoint refers to President Joe Biden's low popularity ratings, comparing them to those of Jimmy Carter during a challenging economic period. He suggests that people's dissatisfaction with the economy, rather than other factors, drives Biden's unpopularity. Schiff also highlights alarming economic indicators, such as record budget deficits and trade deficits, as evidence that the economy is not as strong as it may appear. He argues that a booming economy would result in smaller deficits and increased tax revenue. In response to potential criticism about his predictions of hyperinflation not yet materializing, Schiff maintains that the economy operates based on certain principles, and he sees recession or depression as either ongoing or inevitable. However, he clarifies that he does not believe the economy is currently in a depression. Schiff offers a sobering perspective on the economy, challenging the perception of growth and highlighting indicators of economic distress. He emphasizes the importance of scrutinizing economic realities beyond surface-level statistics.
Back in the early days of the 2008 financial crisis, based on the way the government reacted to that with quantitative easing, and I knew that the road that we were going down could lead to hyperinflation. Now, I always said that was a worst-case scenario. I never said, hey, it's for sure. But of course, the media, everybody picks up on my warnings of hyperinflation. I still think that hasn't been taken off the table.
Schiff acknowledges that Americans are in a deep hole economically, and climbing out won't be a walk in the park. The road to recovery is uncertain, and everyone should be prepared for some challenging times. One crucial factor he highlights is the role of the government. How they react to this crisis could significantly impact our situation. It's a wild card that could either ease or worsen our predicament. Now let's talk about hyperinflation. Peter addresses the specter of hyperinflation. He recalls his warnings about hyperinflation dating back to the early days of the 2008 financial crisis, a worst-case scenario that he never claimed as a certainty. The media often latches onto these warnings. Still, Peter maintains that the possibility of hyperinflation hasn't been completely ruled out. He suggests that the odds of it happening have increased over time. However, he tempers this by clarifying that what he saw as inevitable was high inflation, a prediction already starting to come true. While it's essential to note that he's never claimed it's a certainty, his concerns have resonated with many. The possibility of hyperinflation, though not guaranteed, is still very much on the table. What he's been consistently predicting is high inflation. We've already started to see signs of this, and Peter believes it's far from over. The recent Consumer Price Index numbers, with an over 9% year-over-year increase, might not be the peak. We could be headed toward double-digit inflation, and that's cause for concern. While it might not be hyperinflation, it's still a significant problem. Schiff also highlights the impact of government stimulus during the pandemic, which he believes artificially increased demand without a corresponding supply increase, thereby driving higher prices. Schiff's assessment of the current economic situation is a sobering wake-up call.
Now, the market just thinks that we can go right back to where we were. They're wrong. That ship has sailed. We're done. The years of low inflation are over. They're not coming back. There is so much inflation in the pipeline. And the dollar, right, is going to start to really fall the minute the Fed stops hiking or indicates that it's done. And that's going to really accelerate the increase in prices. And you have the world now de-dollarizing.
Schiff criticizes the market's assumption that inflation and interest rates will return to lower levels, asserting that such a scenario is unlikely given the Fed's historical missteps. He believes that the markets have not yet fully grasped the magnitude of the errors committed by the Fed in the aftermath of the 2008 financial crisis. Furthermore, Schiff addresses the role of the US dollar as the world's primary reserve currency. He expresses concerns about the dollar's future, suggesting that its status is at risk due to actions taken during the COVID-19 pandemic, such as sanctions against Russia. He believes the world is increasingly seeking alternatives to the dollar, which could have profound implications for the U.S. economy. Schiff suggests that investors should prepare for a shift away from the dollar by diversifying into non-dollar assets, including dividend-paying stocks, in countries he believes are well-positioned for a post-US dollar environment. He also recommends holding real resources such as energy-related investments, agriculture, industrial metals, and precious metals like gold, which he believes could replace the dollar as the primary monetary reserve asset. Peter Schiff challenges the notion that the Federal Reserve can effortlessly steer inflation back to a 2% level, enabling a reduction in the recently soaring interest rates, which have reached a 16-year pinnacle. He contends that this assumption is deeply flawed and that the return to an era of low inflation is improbable due to the considerable inflation already in the pipeline. Schiff underscores the intertwined relationship between interest rates and debt. He emphasizes that the artificially low interest rate environment, orchestrated by the Federal Reserve, has fostered excessive borrowing across all sectors, from individuals to governments and corporations. This surge in borrowing has consequently resulted in an across-the-board escalation of debt burdens. He criticizes the Federal Reserve's quantitative easing policies, asserting that they have effectively quashed interest rates, leading to over-leverage and misallocating resources within the economy. Schiff argues that this has rendered the financial system exceedingly fragile and susceptible to the impending impact of interest rate hikes. Furthermore, Schiff anticipates the Federal Reserve's shifting role in the evolving economic landscape. He predicts a pivot from battling inflation toward addressing an impending severe recession. In his view, this shift will likely involve reducing interest rates and implementing further quantitative easing, actions that may compound the existing inflationary pressures. Now let's listen to Peter Schiff to show you how to survive the upcoming economic collapse.
If you get wiped out and you're broke, what can you do? You don't have the means to help anybody. So preserve your wealth, and then you can help a lot of people as you redeploy that wealth here, right? All the money that we send abroad, we can bring home. After the crisis, in the aftermath of the crisis, we can repatriate all that money and help rebuild what's going to collapse in a better way, in a stronger way, get a viable economy again, not one gigantic bubble.
Schiff concludes with a stark warning about the potential for a financial and U.S. dollar crisis. He draws parallels to the abandonment of the gold standard in 1971, emphasizing that the consequences of such a shift could profoundly impact the U.S. economy and its standard of living. Americans must take proactive steps to preserve their wealth and financial well-being. In doing so, we can collectively contribute to rebuilding our economy, reindustrializing our nation, and rehiring those who have faced the brunt of economic challenges. You are at a critical juncture where your decisions today will shape your economic future. By safeguarding our wealth, exploring international opportunities, and considering alternative assets like gold, you position yourself as the catalyst for a more robust and sustainable economy post-crisis. The path ahead may be challenging, and the title's question about a recession worse than 2008 looms large. However, our collective resilience and intelligent financial choices can pave the way for a brighter and more stable economic future that's not built on fragile bubbles, but on a solid foundation of prudence and preparedness. That's it for today. Thank you for watching. Remember to keep these insights in mind. Give this video a thumbs up, and don't forget to hit that subscribe button to stay updated. Stay tuned for more engaging videos.